So I'd like to draw in our panelists now. Impairment. And you know, earlier I talked about the economic climate. We talked about 2015. Going forward, you know, we see what's happening in slowing emerging economies, China. We're seeing the impact on commodities, oil, perhaps not cyclical, but structural changes. So it just strikes me this whole area of impairment and fair valuations and coming up with appropriate measures has got to be a hot item for this year end. Maybe I'll start with you, David. You know, you fair value. You've got 150 billion plus of assets invested in all sorts of different industries. Fair value reporting. Some of your thoughts and considerations that management and audit committee should be thinking about around that concept of fair valuation, given the current environment.
Well, certainly, Don. I mean, in reality, the value of a company is the present value of the cash flow. So when you're looking at projections, clearly you have to ensure that they're reasonable and in all likelihood reflective of the market. So as such, being on an audit committee, you want to ensure that they have been held to a very high level of scrutiny. And in addition, assuming they're audited, which I presume they are, you want to make sure that your audit team has the expertise in the industry and also the professional skepticism to question the projections. And clearly one of the industries in Canada today that is encountering this is the oil patch in Calgary mostly. And obviously, depending on how you report, whether you report in US GAAP or IFRS, it can make a difference in terms of the impairment accounting treatment. And so if you're on the audit committee, you've got to understand the basis of accounting to figure out how the company is being evaluated from an impairment perspective. And impairment's pretty serious because you can be tripping up on bank covenants and that sort of thing. So it's a very, very important aspect of the whole governance mechanism that audit committees have to look at.
I'm going to come to you, Eileen, in a second. You know, we talked about liquidity earlier. We come touch on that. But David, I'm going to come back to you now as a CFO now at Ontario Teach. What are the things you're thinking through in terms of looking at those numbers that are prepared and challenging and the work you're doing? Is there something a little more this year you're challenging, or how are you approaching those year-end valuations?
Well, obviously, valuations have a lot of inputs to them. So key, obviously, are commodity prices, which are changing dramatically, discount rates as well. So there's a tremendous amount of capital in the world chasing private investments. So therefore, there's a lot of demand for the product, and therefore, in a lot of industries, the discount rates reflect the competitive nature of the scarcity of the product that's in the marketplace. So there's all those sorts of things. Obviously, the quality of the projections is very, very important, how long-term the projection should be, and really what kind of insights you can have by going into the external market and looking at how other companies are valued and what transactions have occurred. Putting those all together, I think, gives you a pretty good understanding of how you should value these companies.
Eileen, we talked about this concept of liquidity and how that can impact values.
Well, when you think about the valuation, for instance, because of the fact that commodity prices generally priced in US dollars, and everybody knows about the downdraft in those, but of course the foreign exchange, the downdraft in loonie is to some degree protecting Canadian dollar issuers against some of that. But I think it's going to be really important that companies who are subject to both of those issues actually are very clear about how their valuation, you know, what assumptions they're using for the valuation, both on the commodity price side and on the foreign exchange side. Because if you're going to do sensitivities on both of those, you're going to get some wildly different kinds of answers, and it's going to be very important. I think one of the things that the roles of the auditors can play is, because they see a very large number of reporting issuers tackling these same issues, that they can give guidance to audit committees about where their valuations may stand on a spectrum, so that they can understand whether they're being very conservative, not so conservative, or whether the assumptions they're using may run afoul of Cameron's crew when it comes to actually reviewing their statements of their MD&A.
Yeah, I think that's a great point in terms of that reporting, and we're talking about simplicity, we're also talking about the power of analytics and data mining, and I think a lot of that can get used both from the auditors to provide a perspective where you sit benchmarking, and in fact, I think management as well, in terms of how they present this information for the audit committee to have a really good and robust discussion around it.
There's going to have to be a much bigger focus on the cash flow statement this year because a lot of the reporting, as we were saying, can be masked by different factors. And the question is, what's in the bank, and how soon do you have to roll over whatever leveraged instruments you might have, and whether or not the debt market is actually going to be there for you.
I'm reflecting back in global financial crisis 2008, and boy, valuation when liquidity dries up, trust dries up is a major issue. That was significant. We had big problems around valuation in that time frame. Are we heading that way, Eileen? Do you see that? It certainly needs to be on the radar screen because I've heard it raised a number of times.
Yeah. Well, the high yield market is gone for the moment, at any rate. David can probably talk about that even more knowledgeably than I can. But I think the fact is that lenders are very, very nervous at the moment. And if you've got something coming due within the next 6 months, the chances are not as great as they were that you're actually going to be successful in rolling that over. So I think it's very important, and that audit committees have that sort of thing on their radar screen.
Perfect. John, in the insurance sector, you've got some portfolio liabilities you got to manage. Any thoughts on this particular issue?
Well, I think aside from the valuation question that Eileen and David have spoke to well, I think as we look at this, we also need to be careful. As an insurance company with a big portfolio, the income from which, or the returns from which, reflect in our income importantly. I think as markets are down and as returns are lower, we really need to watch and think about our risk tolerances and certainly be much more cautious about things we might try and do to get higher rates of return that would put us offside on the risk tolerances we've agreed are important to us. And I think in these times, it really does put stress on some of these measures you put in place to protect your balance sheet.
So I think as you listen to our panelists, certainly that discussion around valuation impairment, it's going to be an interesting one around the audit committee boardroom table this year, perhaps more than people were thinking about. And this concept of liquidity, I think, is an important one. I've heard that raised a number of times, so that's something to keep your eye on. We're fifth year IFRS, and everyone's saying, well, okay, we're through that. Some are happy, some are not so happy around it, but yet there's still something coming. Cameron, what's coming down the pipes that people at least need to be thinking about?
Well, the big standard that's coming down the pipe is revenue recognition, of course, which will be effective 2018 around about that time. And so people do need to start thinking about that now. That's a huge standard. Revenue is one of the most important metrics in the financial statements. And I think some of the key considerations that issuers need to be thinking about and audit committees need to be thinking about is, do you have a detailed implementation plan for this standard? Do you have sufficient resources in your organization to deal with it? Thinking about areas of judgment that you're going to have to exercise and having discussions about that between management, the audit committee, the auditors, getting everyone on board earlier rather than later, and managing investors' expectations. That's also very key. So providing disclosure about how that standard is going to impact you before it impacts you. So disclosures in the years leading up to that standard when the information is ready, trying to provide investors with context sooner rather than later is important.
So I think that's a good point. It's a ways out, but you need to get prepared for it. And I think if you're in the telecom industry, construction industry, this revenue recognition and understanding and working through is going to be quite complex based on some of the training that I've been through on the topic. The other thing, I guess, is leases too, and whether a lot of those leases end up on the balance sheet, which could be an interesting situation down the road. So keeping an eye on that. One last, just always of an interest point, Cameron, is around the U.S. U.S. GAAP and IFRS, during the downturn, we were going to converge. We're going to find one, global set of standards. That seems to have dropped away. Where's kind of the latest view on that in the U.S.?
Well, I think the topic of having a single set of high-quality standards is still very prominent, not just globally, excluding the U.S., but also in the U.S. They are supportive of that. Their steps are a little bit more cautious, I suppose, in how that moves forward. The latest proposals that are being worked on are to have IFRS information as supplemental information to the U.S. GAAP information. So that is coming. That strong signals have been made about those rules being worked on. And that maybe is a good first step for the U.S. markets to try to embrace that information.
So we are going to continue to live with some differences as we converge, I guess we'll use the words. David, you had a great example, and it ties back to what we're talking about, impairment, right? And the difference between IFRS and U.S. GAAP in the energy industry. Maybe share that with the audience.
Well, it's interesting today in oil and gas accounting. If in fact you're under IFRS, you can actually look to the future value of oil as you do your projections going forward in coming up with your view on the present value of the company. Under U.S. GAAP, you really can't. So it's interesting where a company under U.S. GAAP would have an impairment, whereas a company identical using IFRS would not. And that's why it's really interesting if you look at the after effects of an impairment, which is you have to deal with bankers and regulators and everything like that. Really important for the audit committee to reflect on what standard of accounting they want to have. IFRS, obviously, if you're a multi-jurisdictional reporter, you can use that for Canada and the U.S., but a number of U.S. Reporters, obviously in Canada, want to use the U.S. standards so they're comparable to U.S. reporters, but it does have that limitation.
It is interesting to take a look, two different reporting models, one impairment, no impairment, as you work through a fair and balanced approach at year end.